to this standard on financial instrument, and this standard has been so much very, very challenging even to take read of the IPSAS B itself. This standard has been in different projects since in FRIs, right? So in the formula, I will just go for the simplest. Currently, we are having this. So we have IPSAS 28, we have IPSAS 29, we have IPSAS number 30, and then we have IPSAS number 41. IPSAS number 29 has gone. And this year, the government has announced through its technical pronouncement number 7 of 2022, which was issued on May. The government announced all public sector of the year should go through this IPSAS number 41 after the invasion from 29. And the Paymaster General, through the Accountant General, insisted training to be done through the Accountant Officer so that all preparers, including internal auditors, accountants, and all members should be aware what are the main changes from IPSAS 29 to IPSAS 41. Am I clear? So we have to take this as a serious issue. And this is from January 2023. Tanzania has gone to IPSAS 41. So this is take that this diploma in IPSAS, maybe an examiner can be interested to do what? To ask what are the main changes that pertain moving from 29 to 41. That is very important. So, before going to this standard, I would like to make or to address some key issues so that you may be understanding from the grassroots, right? One of it, if you are not aware on a financial instrument, you should be aware on the elements of financial statements. You remember? Elements of financial statements. That includes what? Number 1. Number 2. Number 3. Equity or net assets. So, remember also something called taxpayers. Taxpayers' funds. So, these are the elements of the statement of financial position. And then, in a nutshell, we have something we call revenue. And then, we have expense. So, let me say, what's the difference between expenditure and expense? Who can explain to me? What's the difference between an expenditure and an expense? Yes? Cecilia? Can you tell me the difference between these two? Yes. Yeah, from Ngorongoro. Any difference? Okay. Let us see what we can see here. Can you tell me the difference? You can't. An expenditure may be classified as capital item when a public sector has bought a machine with useful life more than 1 year. Then that is a capital item. So, such expenditure will form an element of asset correspondingly. You see? Therefore, an expenditure is capitalized in balance sheet. Capital items. When you buy a property, plant equipment, a buildings, and others. So that is a capital item. But if you buy or you pay wages and salary, there is no corresponding asset on it, then that is an expense. So you expense it in financial statement. Number 2, if Ngorongoro build a road infrastructure which is temporary because of seasonal activities, then if you incur an expenditure in respect of construction of seasonal roads, then such expenditure is expensed because no capital item in the form of road will be recognized in the balance sheet. So it is expensed. So as you measure expenditure to be capitalized or expense, it depends on the way you treat or the resulting impact on that policy. Do you see? Therefore, road construction on temporary issues with an output that does not exceed 1 year, it is what? Expensed in the statement of financial performance. And it changes presentation. Where do you locate such expenditure? It changes recognition. That's why in borrowing cost, you have an alternative to capitalize and you have a benchmark to expense. Once you select one of these, you change the recognition of expenditure and you change its presentation, and that is an accounting policy in IPSAS number 3. Am I clear? So, we have these key issues. I will explain. Why do we have financial instruments in different grounds? Right? So, this is the way I want you to understand. Now, let's see what was the CAG observation so far in respect of what? Financial instruments. So, we should be aware if a CAG is also observing something, isn't it? So, the CAG is saying that in a 10 sample of entity financial statements for their ending 2018, he is auditing the consolidation financial statements. Do you see? So in this sample of 10 sample, with equity investment. So he's talking about what? Equity investment. Now, later I will explain that equity investment is a financial instrument. So you must notice that equity investment is what? A financial instrument. I will explain in the near future. So he said that equity investment held for trading. So this equity investment is held for what? Trading. So we have equity investment which are held not for trading. You get the point? So he's talking about equity investment held for trading. The CAG noted that the investment lack details disclosure of market price of share and the techniques used to measure the share with the quoted price. So it is a requirement in IPSAS number 30. I repeat, it is a requirement in IPSAS number 30 that all public sector which held equity investment shall disclose the following. 1, number of share. 2, market price per share at reporting date. Subsequently, you compute the fair value of equity investment at reporting date. Failure to disclose the market price, the number of share, and the policy which has been used to compute those shares, then this is an audit queries as per CAG guideline. You own equity share somewhere, remember to do what? To disclose the price of share, the number of share, and the fair value of those shares at reporting date. So about also out of 10 sample of entity, he said 9 lack detailed disclosure of the number of share only, except the PPF. This is contrary to IPSAS number 30, paragraph number what? You see. So financial instrument is a key issue for we students in diploma and IPSAS to understand the details so that we can be able to extract a good quality financial statements in our office. Am I clear? So this is how the SAG is arguing on elements of finance, on issue relating to what? So he has shown this table. So this is an example of public sector in Tanzania which are lacking detailed disclosure. Number one, he said PPF. So as you see PPF, the opening balance of equity investment is how many? Almost how much? Do you see? The closing balance has been stated. So PPF has complied by trying to disclose the difference in price. Now look to local governments, loan boards. Opening balance, how much is that? How about closing balance? Is the same. This is misleading. It's not practical that a price of share in January is the same as price of share in December. This is quite misleading the reader. So the SAG is arguing that a public sector shall be responsible to report what was the price at opening balance and what is the price at closing balance, so that somebody can now compute the gain fair value of equity investment. The same to KRDC, you see, same to Kigoma Ujiji, all these PPA, PSPF, and others. So this was a query, and I'm sure after having known some of the cases in this financial instrument, you will be able to solve these queries and be aware on the compliance to IPSAS number 28, 29, 30, and the letter 41. Am I clear? Okay, so let's see me portray to another. What's happening here? Again, he is saying the following. Equity investment held at the same value. He said, CAG reviews the note of equity investment was for trading among this one have remained relatively the same throughout the period. And this one is contrary to paragraph number what? 48 of IPSAS 29. This standard has been overtaken by events. So a corresponding paragraph has been made in IPSAS number 41, requiring public sector to report fair value gain, to report the price and other cases. Am I clear? Let us see to another portion whether they happen. So he has shown us the same table for evaluation. So I should not go for details on this because actually I want to concentrate on understanding. If you understand what I'll be talking here, you are going to become a teacher on a financial instrument. So this is some of few audit queries that emerges during the CAG observation. So let us see other parameters now. To start with, what is a financial instrument, isn't it? I told you there are almost 5 elements of financial statement. Don't see it. And then there are 5 key issues relating to financial instrument. Number 1 is definition. Number 2 is presentation. Number 3 is what? Measurement. Number 4, disclosure. Number 5, recognition. Now, you see these 4 cases. Do you see these 4 cases? Out of these 4 cases, I am going to explain about these 4 cases. Because the definition cut across those 4 other cases. So, I will talk about presentation. I will talk about what? presentation. What is presentation so far? Who knows? Actually, presentation is a process of locating an element in a financial statement. Where should you locate it? For example, if you have borrowing cost and you have opted to capitalize, you present it in the balance sheet. If you have opted the same amount to expense, where do we present? In the statement of performance. You say, so presentation, where do you locate? If you have expenditure, you have used it to buy a motor vehicle, where do you locate? In the balance sheet. That is presentation. If the same expenditure, you use it for other charges, including electric bill and others, you should do what? Expense it in the statement of financial performance. So, presentation, where do you locate? So, if this is the expenditure, I'll just put something. You can capitalize. Or that's expense. So if you capitalize, you present it in the balance sheet. That is a good news. Now, if you expense it, you present it in the statement of performance. I want you to understand these key issues. The same borrowing cost. So, borrowing cost, you can capitalize it. Once you capitalize borrowing cost, where you present? In the balance sheet as an asset. If you expense borrowing cost, that one will go to performance. So your performance in the balance sheet. So borrowing cost is with Ipsas number 5. Again, we have research and development, R&D. So research and what? Development. This is in Ipsas 31. You can also expense R, or research shall be expensed. So research is expensed. But development cost shall be capitalized when it missed 7 factors in Ipsas 31. So you capitalize. So once you expense it in performance, once you capitalize it, it's where? In the balance sheet. Now, financial instrument has to describe which standard to deal with presentation. So the ISB initially in the private sector, it issues IS 32 in order to put a demarcation of how do you present financial instrument. You see. So IS 32, rooting from ISB in the private sector, it has a policy. It is since 2010 of its amendment. So it has a demarcation of where do we present financial instrument. Accordingly, the IPSASB, as a board in public sector, has now amended IS 32 to IPSAS 28. So this IS 32 has been amended to IPSAS 28. Do you get me? So IPSAS 28 deals with only presentation of financial instrument. Am I together? Yeah. So this is, want you to be aware on these issues. Very technical issues. So in a financial instrument, at least every key issue in financial instrument has its own standard. So IPSAS 28 does explain about what? Presentation of financial instrument. Do you get me? So I want you to be technical on it. Now, in order to present financial instrument, you should have a value. You see, for example, failure to recognize financial instrument in balance sheet. You have to think, at what value should you present it in financial statements? So again and again, ISB as a body in the private sector has its own discussion on how to get a value of financial instrument. So it has something called recognition and the what? Measurement of financial instrument. Now, the term recognition means it is a process of incorporating an element of financial instrument in a financial statement. So there are some financial statements which can arise, but it can miss recognition criteria in the financial statements. And remember, when I say financial instrument, there are some financial instruments which are not accounted in IPSAS 28 or IPSAS 39. So at this point, the IPSAS-B amended IS 39. IS 39. So IS 39, this is a financial instrument in the private sector which is routing from FRS. You get the point? So in 2010, the IPSAS-B has taken this standard to amend to IPSAS 29 so that it is in line with public sector entity. So at this ground, what now we're going to is to see this amendment in which standard? IPSAS 29. As I said, remember very carefully that IPSAS 29 has been overtaken by events to IPSAS number 41 because of the key issue that I'm going to explain so to become comfortable. So at this I was saying, IS 39 is in a private sector entity. And IPSAS 29, it is what? In the public sector. So if you read between the line, you could observe that IPSAS 29 has been taken from IS 39. Am I clear? So this is recognition and measurement. So recognition of financial instrument has been dealt in IS 39 or IPSAS 29. So it has some criteria on how to recognize financial instrument. You cannot recognize financial instrument as you did in other assets or liability. So it has some key issues which I'm going to explain here so that you become more comfortable on it. So now we have discussed about how many key issues? 3. 1, presentation. 2, recognition and measurement. So we have been left with how many? 1 only. Because the first one is definition, isn't it? What is missing? Disclosure. Good news. So disclosure, which is, now let's put it in a... Now, do you know what is measurements? Do you know the definition of measurement? What is measurements and what is recognition? I said recognition is a process of incorporating an item of financial instrument that meets a definition of financial instrument in financial statements. But measurements is a process on how to arrive to a value of an element. How do you get the value? And that's why we have different methods of getting values of elements, either asset or liability. For example, We talked last year, in last period, that when you are dealing with owner-occupier, you can recognize an asset initially at cost. And of subsequent, you can select what? Another model, isn't it? And if the asset is obtained through exchange, you can use what? Fair value. So that is how you obtain a measurement. How you have the value of asset in your financial statements. That is measurements. And I say, if you want to make or you want to find the value of a cow, a value of a goat, a value of any biological asset, what we say? Initially, we said use what? Fair value model. Because the biological assets are reported at fair value model. You see tracks. If no information is available, the standard permits to depart to cost model. Do you see? So this is measurements. How do you get a value of an asset, a value of elements in the financial statements? So IPSAS 29 explain on how to get the value of what? Of elements. Now let's see the last one, which is what? Disclosure. Say disclosure. What is a definition of disclosure? Who can tell me? Yes, Cecilia? Cecilia, tell me. Definition of disclosure. For example, if your husband has received a salary and he can't show you a pay slip, you see, so a pay slip has been hidden somewhere with a latent virtual image. So you are saying he is not disclosing the pay slip. So to disclose is to show explicitly, openly, that an event has happened. If you are dealing with revenue collection, in local government, for example, you are collecting service revenue. Always you used to issue invoice. You see, upon that invoice, you receive cash. So we should start auditing from every month how much has been collected from different taxpayers. Now, if an accountant is now trying to hide some invoice and some taxpayers so that the transaction does not appear in the financial statements, so we are saying there is lack of disclosure of events. So the auditor will issue a query that there is lack of disclosure of what? Events. Now, if you bought a motor vehicle during the year, and the motor vehicle is there, and a tax invoice is there for acquisition of motor vehicle, but the accountant has not included such motor vehicle in the PP schedule, so I'm saying there is lack of recognition in the financial statements. So you must be aware these two terms, lack of recognition and lack of disclosure. Those are the terms used by the supreme auditor to issue audit query. You get the point? Now, if you bought a motor vehicle, or if you receive a motor vehicle with no value because of donations, isn't it? But now, you have shown a motor vehicle in the books, but with no value because you don't have invoice. So the auditor is saying, oh, no measurement are there. Because how do you get this one? So you have to establish measurements basis. You see, so you should be very much aware on how this information have been assessed during auditing so that you become a professional accountant in the other departments. So disclosure is to show it. For example, if you have financial instrument, for example, you bought shares, and you show them in the financial statements that you bought a share of 40 million thousand. You see whatever the case works. So you have shown them. Now, disclosure is how the standard is insisting that if you own, I repeat, if you own financial instrument, what are the corresponding issues to be reported in financial statements? So the standard dictates that if you own a financial instrument and you have disclosed them in financial statements, correspondingly, you must disclose in the notes the following. One, the date of acquisition. Two, the number of share. How much share have you bought? Three, the price of share at acquisition date. Four, the accounting policy that you are going to use to measure those shares initially and subsequently. Five, you have to explain if there is any gain or loss because of those shares. Six, you must explain the risk associated on having those shares. For example, if you own shares in respect of Green Bank, do you know Green Bank? Do you remember the Green Bank? Or the FM Bank? Do you know the FM Bank? Don't you know the FM Bank, which has been liquidated by the BOT? Do you know it? Now, if you own shares of FM Bank, and there is an announcement that a BOT is now going to seize the bank, then an accountant must disclose the risk associated on those shares because of liquidation. If you own financial liability or financial asset, and the market price of those shares or bonds has gone into problem. For example, during COVID, some people had bought treasury bonds in BOT, but other people were owning shares in CRDB Bank, the private entity. So during COVID, the banks were not trading, and the banks has ceased to pay dividend because of bad financial status. But the BOT went on issuing coupon income because the bank never go into bankruptcy. So the bank is a risk-free financial asset. That's why in the portfolio, we are insisting entities to buy share from BOT, to buy bonds from BOT. Why? Because once you invest in government bonds, they are risk-free. So if you own a financial instrument, you are supposed to disclose the corresponding risk associated with financial instrument. If you are highly indebted, perhaps you have some bonds, you issued bonds, and you are now not able to pay for the finance cost. That is a financial instrument. So there is a risk of default. Now, if you default from payments, then it's possibly the lender can confiscate your asset. So what we are saying, a public sector must report the risk associated to confiscation. Because if you have more debts in our country, it's a problem. So you must disclose the risk associated with those loan amount. Remember in Kenya, against Chinese. Remember Chinese loan against Australia, against Zambia. So if you fail to pay the interest from loan amount, what will happen? The airport will be taken. You see, many of these, so these are some disclosure which you must disclose them in a financial statement so that any person who is interested, any investor must understand clearly what are the risks associated with the financial instrument in your books of account. So this standard was from FRS number 7 in the private sector, and therefore this standard were converted to where? To IPSAS number 30. So I have talked to you about 3 standards in the financial instrument in the public sector which correspond to where? To 3 standards in the IPSAS. So you must be able to collaborate this one. So what happened now? I will make a summary so that you don't get problem in reading financial instruments. So number 1, we have IS 32 presentation. Number 2, we have IS 39. Now in subsequent years, IS 39 has gone to where? FRS number 9. Do you see this one? So now see the problem now. Having done this, IS 39 has inverted IPSAS 29. Because of certain circumstances, I will explain better known by the reader, there is an amendment from IS 39 to where? FRS number 9. Therefore, IPSAS decided to, based on this standard, to issue IPSAS 41. As I said, IPSAS 41 has been adopted by the Master General in Tanzania, and we are at start this January. So financial statements for their ending 30th June 2023 must accommodate IPSAS 41. So be aware that an examiner may be interested to handle this as one of the key issues to explain. So IPSAS 32, remember, we have IPSAS 28 and no amendment. And therefore, FRS number 7 has gone to where? IPSAS number 30 and no amendment. Now, I will explain some key issue on the reasons of amendment. Reasons for what? Amendment. Very summarized. Reasons for amendment. So we are talking about moving from IPSAS 29 to where? IPSAS 41. There were almost 3 key issues that I'll make it for you to understand. The first issue, and very serious, is impairment. Impairment of financial instrument. That issue was very serious. So impairment of financial instrument in IPSAS 29 has been amended. The way impairment is being treated in IPSAS 39 has been amended to other policies. Am I clear? This impairment is, as for example, this impairment of financial instrument in IPSAS 29, it was backward looking. But impairment in IPSAS 41 is forward looking. What's happening? The term impairment here, it means bad debts. Can you repeat after me? I say what? Bad debt. For example, if you have rendered a service, you have rendered electoral services to the government of Zanzibar. You see, if you have rendered a service of electoral service to what? Government of Zanzibar. Therefore, TANESCO will book receivable in its books of accounts, isn't it? Now, the term impairment says that if you are looking forward to see that the government of Zanzibar is not able to pay me, and you have used your effort maximum to collect such amount of receivable, you have failed. So that is, you have failed to collect receivable, and on the future, you are not expecting to collect it. So in this ground, through IPSAS 41, TANESCO is advised to write off bad debts. You get me? This bad debts is not called bad debts, but it is impairment of financial instrument, because the receivable is an example of financial instrument. If you are working at university in the public sector and the student has been enrolled, all procedure for recognition of revenue has been met. Do you get the point? But on subsequent, a student has been discontinued to continue with because of pending examination and other tests. And the students has gone home. But in your books, you have recognized receivable from the same students. You see, are you expecting to collect tuition fee from such students? Now, if you look forward looking, then a student can't pay tuition fee. Therefore, such kind of receivable has gone into impairment. Am I clear? So this is the future forward looking in IPSAS 41 in respect to receivable, that a public sector should look forward and estimate possible default of customer to pay receivable and put an expense to financial statements because you are not able to collect it. So if you have receivable and you know from your heart that you can't collect such receivable, in actual fact, there is what? Impairment. That was fact number one. Number two, it was classification of financial instrument. Actually, in IPSAS 29, IPSAS 29 has a rule-based classification of financial instrument. It was rule-based. Am I clear? IPSAS 29 has a rule-based of classification of financial instrument. It has only included 4 classes of financial instrument without reasons as to why do we classify in such a manner. So it was a rule-based. It was a mechanics using force to pick 4 classes only. The rest, no way out. Now this one has gone through different exposure draft. And now, IPSAS number 41 classified financial instrument using business model. So IPSAS 41, it is a principle base of classification of financial instrument, and it uses what? Business model and cash flow contractual cash flow characteristics. Am I clear? The last reason, it is what? It is derivative instruments. So there were changes in derivative. So this project is still going. So the way derivative are treated in financial instrument in IPSAS 29 is quite different to what happened in IPSAS 41. So these are some basic reasons as to why the IPSAS B has gone into amendment of such problems. And remember, this new amendment was because of FRS number 9. Am I clear from there? So please, once you are reading the financial instrument, you should not go in details, because I'm sure the standard itself has more than 1,000 pages. So you see how it works. But it has some key issues. For example, derivative instruments are not applicable in Africa because derivative only applies to strong currencies such as dollar, yen, Canadian dollar, Japanese yen. We have all other strong currencies, including euro and pounds. So in Africa, we are always thinking for South African dollar South African rand to be the strong currency. But other currencies are weak currencies, and then we don't have what? Derivative in Africa. Am I clear? And even in London, we have some currencies. For example, the Chinese. It's not as strong as trying to deal with this derivative. So I think from there you can get something, isn't it? This is the introduction. Any problem? Yes. Yeah. Ndio. Inakuwa swali lingine ni nini? Mpiga makofi hapa. Unajua, having a description on that, we need some of the cases in there. As I said to you, we are here to have acquitted knowledge in the public sector, and specifically to know something which was missing presently. First of all, I'll start with what is the IS, and why IS and why FRS. Do you get the point? Yeah? Am I clear? Okay. Let me pick some of the key issues so that you understand from me, although it is not part of this standard. Remember, it's not part of the standard, but it's part of diploma in IPSAS. Okay. In 1973, Dr. Benson in London himself had to write a book. That book was acquainted to enforce the world to understand and use rules to prepare financial statements. You see. So, prior to that, there was no board, no IFAC, but it was just a congregation of accountants to discuss issues of accountant, but there were no rules. You see the fact? It is from there Dr. Benson wrote a book suggesting the meeting to adopt the books which consist standards. And from that book, IS, now this International Accounting Standard Committee was formed in that year. And this committee discussed several issues and reached consensus to have standard. From this committee, the committee stated that standard must be particularly to certain treatment of events, transaction, elements, and others. It started issuing IS number 1. So as you see, IS number 1, it has some initials from this committee. So the term IS is International Accounting Standard. And the committee was called International Accounting Standard Committee. It was just a committee formed during this year. This committee was there to enforce, to suggest, to encourage the members to have common reporting. And this committee has board members from big nations, including UK, American, and others. I can't go in details. So this committee formally, it has issued IPSAS number 1 to how many? Sorry, IS number 1 to IS number 41, which is agriculture. Am I clear? Now, in 20, through this year, 2020 to 2023, during the president of George Bush in America, you must understand clearly, during this year, most of the public corporation, like what's happening in TANESCO, TTCL in Tanzania, and the other public corporation, which is state-owned in different nations. In London, we have buy system and the others, right? These standards were using private sector arrangement. For example, in America, they were using GAP in America. In London, they were using this IS. Now, the problem comes that these public corporations were not much using appropriate reporting framework, because a public corporation is aimed at rendering the services. And even the board of directors from those corporations, they were not strong. They're not having a strong internal control system. So these people, member of the board, were also the member of parliament, were politicians. They started stealing money of the corporations. You see. Accordingly, it happened to have fraud. And because of their big potato, they managed even to use some of the parameters in the financial reports to create accounts. So creating accountings is a problem whereby somebody uses technical issues in FRS which permits treatments so that they can steal money. The external auditor for American Enron was Sir Arthur Anderson. That was the external auditor. So in America, we have Enron scandal and the Wedicom scandal. These were the company, very big company in America, which collapsed to hell because of this creating accounting and other issues. So this company, Enron and the Wedicom, were using these private sector standards in America. Because of that, it happened that they were creating accounting and there were no good governance. So the public officials were stealing money from the public corporation, as what happened in Tanzania as it works. The case maybe in the TPA, in TANESCO, the case of escrow and the other cases, which you understand, multi-billion money has been taken. Now, George Bush initiated a committee within the Senate, in the parliament. This committee included a politician and some technical expert. And the report was called what? Oxley. It was what? What? SOX. What is its name? SOX. Sarbanes-Oxley Act. So this act has gone through from 2003 to 2023, from this period here. So the report now came to see there were some shortcomings with reporting framework. And it is this period when in IPSAS, public sector committee of IPSAS were converted to IPSAS B, so that all public corporation will be reporting using a separate reporting framework to differentiate it from profit-making entities. So in this period, the following happened. I will explain it simple. Number one, the IS, this board, right, has a discussion with a board in America, funds B, to discuss issues of shortcoming in standard in America and also in London. In this board, ISAC was superseded by ISB. So this one no longer exists. So in discussion, ISB, International Accounting Standard Board, was in discussion with this board. In these years, they reached a consensus that whenever a private standard has been issued in America, the same standard will be absorbed in London. And they exchanged the board members. And they took a very serious issue on convergence. In fact, Americans were converging to UK. From that combination, they formed a new board, a new foundation, called what? FRS Foundation. So instead of having Isaac, we have now what? FRS Foundation. So this board started issuing FRS instead of IS because of its initiality. You see it? So FRS number 1 is a first adaptation of FRS. FRS number 2, it is a share-based. FRS number 3, it is public sector combination, etc., etc. So this board started issuing what? FRS. Number 1. So from the same year, we have what? IPSAS-B. So IPSAS-B was to convert IS and FRS to IPSAS. That is a short story. I think you understand. Now the second question is about what? Derivative. Yes, derivative is what is derivative so far. Actually, derivative, I will explain in the second discussion on what will be observing. Let us see. I will ask that question, but remember, try to remind me. Let me explain the essence of financial instruments so far. What is the essence of financial instrument? The essence of financial instrument is routing for financial management. If you had a company, and remember this company is a listed company because all standard must deal with listed company, and you have source of finance. Do you get me? So source of finance, stakeholder. From where? Who brings you money? You see, where do we get money? Number 1, you issue share. So if you issue share, you make them to be traded somewhere in stock market, isn't it? So number 1 is you issue share. So a source of funds is a shareholder. That's number 1. So you issue what? Share. Number 2, this share has now a very good name, which I want to make it here. Instead of saying shareholder, you go further, you issue equity. We call them, when I say equity, it's a very common name. Shareholder, and then equity. So we have equity instruments. Okay? So you can issue equity because of what has been stipulated in the prospectus or in the memorandum of association. So you issue them to be traded in public. Remember, must be traded. We have traded and OTC. Sarah, what is OTC? And what is traded? When I say traded, means they are traded in the public through stock market. When I say OTC, means it is over counter. They are traded confidentially of market portion. Do you see how it works? Now, this equity must be traded. If equity are not traded, it is out of scope of the standards. Remember this one. So if you don't have equity in the books, we have to go to debt. So if you have issued equity in the books and the all equity has been bought, so where do you go? Debt. So debt instrument. So we have equity instruments and what? Debt instruments. Those are sources of funds. Number 3 is when you have derivative instruments. So we have equity instruments, we have debt instruments, and we have what? Derivative instruments. You see how it works? And both of these must be traded. I'll explain. Now, should be understanding this one because you told me to explain detail. So I'm going on in detail. So this is a company. Get the point? So a shareholder will buy share from the company. Accordingly, the company must pay dividend. You see? Now, the dividend payment is a cost of equity to the company. A debt holder will buy traded bonds here. Accordingly, there is what? Payments of coupon income. You see? So, these are the cases. The same to derivative instruments, as I will explain. And there is a corresponding transactions here. So, we have category A. The company will have A, will have B, and C. Stakeholders in their financial statement. So you have category A, B, and C. Now, what is now happening? It is a two-way flow. Do you see? It is a two-way flow. A shareholder is buying share. A company is paying dividend. You get the point? A shareholder is buying bonds. A central bank is paying coupon income. Now, let's start from these two cases first, so that you understand what's financial instrument from its definition. So far, I will start with the equity instrument. Number one, I will explain the term equity instrument. As I said, equity instruments are traded through stock market. I repeat, equity instruments are traded through a stock market. So, equity instruments is called an equity instrument if and only if stated as follows. For example, I will put the following classification here, and you will understand why do we call equity instrument in these standards. Number one, we have 0 here, 0%. Number two, we have 20%. Number three, we have 50%. And last, we have 100 what? Percent. So equity instrument, an investor is buying share from the investee. Remember, we have investor and the investee. Investor is somebody who is buying share. Investee is somebody who is selling share through stock market, not OTC. Now, if an investor buys share of a certain investee and its ownership is below 20, this is financial instrument in IPSAS number 28. Do you get me? So if ownership is below 20, then this is financial instrument. Its name is called the equity investment. It's called what? So this is equity investment, meaning you have invested in equity. And the standard corresponding to this dimension is IPSAS 28. So here we have IPSAS 28. If an investor has bought equity investment ranging from 20 to 50, I repeat, if you buy share ranging 20 to how many? 50. This is significant influence, and it is accorded as investment in associate. The corresponding standard is IPSAS number 36. So we have IPSAS 36. So this one is called investment in what? Associate. Do you understand me? So this is investment in associate. So it's not always a financial instrument saying that, okay, this financial instrument because I bought share. So you have to think, what is the content of those shares? You see? If it is a 50-50, somebody has bought 50% and the other 50%, that is animals control. That one suggests the joint arrangement. So this one might suggest the joint arrangement if it is 50-50. That is, we have animals control. That is IPSAS number 37. Will apply. So it will depend on IPSAS 37. If you buy share above 50, this is a consolidation in IPSAS 35, and the other factors will prevail. So this is now IPSAS 35. Now we are talking of consolidation. We are talking of subsidiary accounting. So in examination, you will be given some scenarios, and an examiner can ask you which IPSAS to apply according to this situation. And that's why we need to be very much clear on getting started on these policies. What are the conditionals and where to say anything? Am I clear from there? Now back to our standard. So if you bought 30% of shares, you have to think, is it an investment associate on a conditional, or a financial instrument, or a subsidiary, or IPSAS 37? Am I clear from there? Now let's go further. So when I say equity instrument in IPSAS 28, the ownership must be below 20% of the investee. Am I clear? Okay. Although there are some conditions, I will explain, and you will understand it, where it departs. Now, what happened in the stock market? If you buy share, an investee will receive money, and an investor will receive a share certificate. So, in the stock market, what is happening? I want to make it clear and very understandable. So, in the stock market, we have two people, an investor and who? Investee. So we have investor here, and also, let's put it this way. Investee and investor. Am I clear? So in between is the stock market. You see, first step, the investee must float share to the stock market and place details. I repeat, and place details and particulars that the company is intending to do what? To sell share. The company will do so through brokerage agents and others. The stock market will accordingly take those particulars and prepare the share certificate to a buyer of share, in any case maybe. So a share certificate is here, will be issued here through the stock market. So this is share certificate. For example, Nairobi Stock Exchange. So the share certificate will indicate a trading market. We have Dar es Salaam Stock Exchange. We have South African Stock Exchange, which is Durban. We have the New York Stock Exchange. We have London Stock Exchange. And that's why in China, most of the company Chinese, they used to float share in London. Because London is the hub of the world. So most of the Chinese company, Japanese, they used to float share in London. That's why when there is a problem in London, you see, most nations will suffer because they are trading in London. The same in New York. So big company would like to trade their shares in these big markets. You see. So when COVID arises, it has a problem because these trading centers were now collapsing because a number of investors were withholding funds. They were selling share because they would not like to invest anymore. They would like to have cash in hands. So this stock market were shaking. And that's why we have this problem of cyclocurrency, because actually the cyclocurrency is at risk. And even introducing it, because actually this market is very liquid and actually it has a lot of scenarios which you need to research. And even the central bank has announced to continue researching because even some big nation has withdrawn from their research because actually they can see what? Risk. And much risk exists in derivative instruments, as I will explain. So derivative instruments will include swaps, option, and futures, which are very risky as it works. I will explain on nature the way it works. Actually, these are the market which is almost involving big currency and very big banks with a huge transaction in other cases. Now let's see what happened here. In the transaction. So an investor will buy a share. So an investor will have two accounts. The first account is a bank account. And the second account, because once an investor pay money, corresponding, the investor will recognize the equity investment. So this is equity investment, and this is the bank as to work. Am I clear? So, for example, if the investor bought 30 million, if the investor pays 30 million to acquire 40,000 shares, you see. So what's happening? The bank will credit the member. The bank will credit. So here, you write equity. Now, this is initial recognition. Equity. You write what? Equity investment, 40 million. Am I clear? Corresponding, there is equity investment, bank. How many? 40 million. So these are journal entry in the books of investor. Debit and what? Credit. So you debit what? Equity investment, and you credit bank 40 million. Disclosure notes, you must tell the reader how many shares were acquired. You must tell the reader what was the price during acquisition and even the transaction cost during the acquisition. Accordingly, if the investor pays this money, he will be awarded a share certificate. So it's another disclosure because that share certificate is a very important evidence that you have bought share. And it is this financial instrument, it's this share certificate which is called a financial instrument. So a financial instrument is a document which indicates that somebody is paying and the other is receiving. So a share certificate is a financial instrument in respect of equity investment, indicating that somebody is receiving dividend and the other is paying what? Dividend. So investee, in this particular, we have also two accounts. The first account is called what? Share capital. Share capital. The rest is called bank. So the investee has sold the share. So in respect, he received money, 40 million from share capital. Right? Share capital, 40 million. And from bank, this is 40 million. If shares has been sold at premium, you must open a premium account. Do you understand this fact? So in the books of investee, we have these two cases here. So you debit bank, you credit share capital at what? 40 million. So this is how you can see an overview of financial instrument in the form of what? Equity instruments. Am I clear from there? So remember, if you pay transaction cost, during this transaction, I will explain the treatment of the transaction cost, because in fact, they are expensed in IPSAS 29. But in IPSAS 41, there is a special treatment I will explain. In IPSAS 29, all transaction costs, brokerage and others were expensed in statement of financial performance. But in IPSAS 41, there is a special treatment of this transaction cost. Let's see the next item of source of money, which is debt instrument. Debt instrument. Debt instrument. Now, debt instruments, this one include bonds, tradable bonds. Tradable bonds. For example, treasury bills, treasury bonds, and the others. Now, how do you account for? The same as anywhere. Shares. So there is a stock market somewhere. We have investee and we have what? Investors. So at this point, I'll write here investor and what? Investee. At this point here, stock market. So in this ground, we have bond certificate. Am I clear? So investor and investee. So we must look on two accounts so far. The first account is, what's the first account? Bank. What's the second account? This is not equity. So this is not equity. It is having now a very good name called the financial asset. This now, financial asset. Okay, now if you buy bonds that amount to 100 million, so you say financial asset 100 million. Against here, bank 100 million. So debit and credit. You credit bank, you debit what? By how many? Is it clear? Yes. Now let's see for the investee. Investee also will have two accounts. The first one is bank. The second one is what? a problem. So we have bank, and you have financial liability. So in this ground, financial asset. In this ground, financial liability. Remember the following. In equity investment, we don't have financial liability and financial asset. We have share capital and equity investment. Okay, so this one, financial liability, 100 million, and the bank has received this amount to operate a company. So debit and credit. So you have your debit, bank, and credit what? Financial liability amounting 1 million. Am I clear? So this is a second category of financial asset or financial instrument. So this bond certificate is called financial instrument because this certificate provides two people. One, investee to do what? To receive money. Two, the investor to receive money and the investee to pay money. So this bond certificate here is a financial instrument in which two people, one is paying, the other is receiving. I repeat, the share certificate is also a financial instrument because one is paying dividend, the other is receiving dividend. The bond certificate is also a financial instrument because this is a contract between two people whereby one is paying and the other is receiving. That is how it works. Now, in the last one is derivative instrument. Please, and I will insist, don't expect some problem here in derivative because actually derivative instrument has gone out of scope in Africa. And even in public sector in Africa, even in London, they are not using the derivative instrument. So this is just a case set to understand how it works. But what is a derivative instrument? The term derivative is an instrument, is a financial instrument which have got no value. And it gets that value from an underlying asset. For example, if you are working as a chief accountant, you see, and there is a paper, a plain paper, it is not written anything, isn't it? But if it happened, the Paymaster General has sent you a letter and signed on it, indicating that you have been upgraded to a senior accountant. That paper has value because of the wording from the Paymaster General. You see? But before that, that paper has no value. Now, the wording and signature is what we call underlying asset. The paper itself is a derivative because they have no value. Do you understand what I'm saying? Now, let me tell you, in recent research, there are 3 derivatives. Number 1, futures. Number 2, options. Number 3, we have swaps. Those are derivatives. And they are commonly known to underlying asset. Very commonly. Number 1, interest. For example, in the money market, you can borrow or lend in banks, short-term financial instrument. So the interest cost or interest income is an underlying asset. Number 2 is currency. Am I clear? So there are 3 derivatives and there are 2 underlying assets. Do you get me? Now, if you want to make a close examination on it, let me give you what's happening in derivative. Number 1, I will start with number 1, futures. Do you see? So this futures, is a derivative which has no value until when connected to an underlying asset. Now, if an underlying asset is interest, or it can be what? Currency. So the name will change here. So the first derivative, number 1, is the future interest, or interest futures. Interest futures. That is a first derivative instrument when it traded. Again, we have number 2. What this one? Currency futures. So we move to another derivative called what? Option. Now the option also can be interest or currency. So if it is interest, what do you call it? Number 3. Yes? Remember, interest option. Number 4, we have currency option. The last derivative is what? Swap. Swap, we have interest and what? Currency. So the 5th one is interest swap. The 6th one is currency swap. So we have 6 derivatives to be done. But I want to go to the details, but to make you understand in a financial instrument, what are the key issues. Now, this 6 derivative, in its presentation, disclosure, and measurements, is what make the changes from IPSAS 29 to where? IPSAS 41. Because of new amendment in FRS number 9. So I think now I've answered your question. When I say futures, I can't hold the definition. I know the definition works, and I have been solving so much problems and other option and whatever. I want to go in details here, but I was just to tell you how the standard has been structured so far. Now, do you have any question from here? Do you have any question? So if somebody told you financial instrument, you have some idea. Am I clear? You have some idea. And you can tell somebody what is a financial instrument. And currently, we are talking about 2 standards. Okay? Let me summarize as follows to reach a consensus when I want to depart here. So when we are talking about classification of financial instrument, you will be asked to use standard IPSAS 29 and also use standard IPSAS 41. A very good news here. This is a rule-based, meaning robustic, and this is principle-based. Even if somebody asks you, what's the difference? You say, oh, IPSAS 29, the classification of financial instrument is a rule-based, is a mechanics, is a robustics. While the IPSAS 41 is what? A principle-based financial instrument. So at this point, there are 4 classes. Number 1 is say financial instrument trading through surplus or deficit, or financial instrument head for trading through surplus or deficit. So this includes shares head for trading. In this area, shares head for what? Trading. Number two, we have financial instrument held at amortized. Financial instrument held to maturity. This includes bonds. Bond, for example, a 4-year bonds, it is held to maturity. 20-year bonds, it held to maturity. So this, what here? Number 3, we have loans and receivable. In this area, loans and receivable. So loans, if you has a loan, receivable, you expect to receive money. So that was a classes here. And this one is with banks. They trade on loan and receivables. And even the public sector will have receivables on those loans. The last one is any financial instrument which is not as above. It is called available for sale. For sale financial instrument. Actually, let me express this one. This is very technical. For example, if Cecilia is having 2 children who is expecting to go to university on June, you see. Now, currently, she's not having money. So she moved to the central bank and buy financial instrument which will be sold when there is a problem on June. So that is available for sale. So you bought it not for trading, but it is available for sale when there is problem. You see? So it is called available for sale financial instrument because you buy this one and designate it that when there is a problem, you are going to sell them. That is available for sale financial what? Instrument. Yep. You see. Now, this is IPSAS 29, classification of financial instrument. And if you will be asked, briefly discuss 4 classes of financial instrument in IPSAS 41. You must be able to explain and giving some examples. And this one is almost 20 mark, or it can be supported with a simple calculation at least to understand, isn't it? Now in IPSAS 41, there are 2 classes. Number 1, as I said, this classification, it is based on business model. So we have contractual cash flow characteristics and the business model. I will explain how this works. For example, you have equity and you have what? Bonds. So we are going to classify financial instrument using let's say debt here. Let's put here debt. So when it's a debt, you see, is it held for maturity? Then it become amortized. It is amortized. When it is held to collect interest income, then that is a business characteristics. But I will later explain equity here for you to get ready on what happened. So IPSAS 41, then equity. Remember, in IPSAS 29, equity was only classified when it is headed for trading. But in IPSAS 41, it described equity on intention to buy share. Now, listen carefully. There are two intentions when somebody wants to buy share. For example, why should we buy share? So there are two reasons. You can buy share in order to make trade. You get the point? Or you can buy share in order to have power in that entity so that you can sack some of the directors. Or you can buy share from certain entity in order to eliminate competitions, not for trading. In Tanzania, you could see most of industry were bought by investors for strategic reason in order to close the industry and make their business. That was not for trading. It was for what? Strategic reasons. Most of donor countries, including European, Americans, will have some money to buy share in African countries' corporations so that they get power in order to get their strategic reasons to rule African countries, not for trading. So it has been designated that it may happen an investor is buying share either for trading or strategic reasons. When I say strategic reason, means not for trading, including having some other interest. Am I clear from there? So if you buy share, you must get acquainted to understand what is the purpose. If it is strategic or trading. If it is trading, then he said they are held through surplus or deficit. If it is for strategic, they are held through the statement of net asset. They are held through the statement of what? Net asset. Now listen carefully. Transaction cost. So, if it is strategic purchase, transaction costs are capitalized. If it is trading, transaction costs are expensed. Am I clear? Now do you see how IPSAS 41 has gone through principle base, giving reasons as to why there is certain classification. Now, after saying that, thank you for listening, and further discussion will continue tomorrow. God bless you.